Welcome back. I'm Dan Matheson. Glad you're with us. The Scotia Economic Report says there are tentative signs that housing markets are stabilizing in Canada and internationally. Home prices are increasing in some countries in the second quarter, including Canada. And with more on what all this might mean to homeowners and those people thinking to jump into the market, we speak with Peter Kinch, who is a mortgage expert with the Dominion Lending Centres, as well as the co-author of the bestseller, 97 Tips for Canadian Real Estate Investors. Sir, what do you make of the market today? Where is it today? How would you characterize it in Canada? And where is it about to go short term?
Well, Dan, I think we've seen a swing of the pendulum. Back a year ago, everybody was panicking. We had an absolute crisis, subprime crisis followed by liquidity crisis, credit crunch, global recession. And now, about a year ago, we were worried about going into the depression. What we're seeing is the government stimulus package that Mark Carney and the Bank of Canada has created, record low interest rates, emergency rates. The stimulation that they've been trying to create has worked. It's got Canadians feeling more confident. They're going out there and they're spending money, and we've seen a recovery.
A recovery principally because of affordability?
Dan, absolutely. I mean, basic economics 101, right? Supply and demand. And demand is going to be a factor. Prices are a factor of supply and demand. A massive component of demand is affordability. When prices get to a certain point that they get too expensive, now you combine high interest rates. Throw on top of that Canadians are concerned about their jobs. If you start worrying about whether you have a job tomorrow, you're not likely to go out there and buy a big ticket item like a house. Mm-hmm. But you know what? Bank of Canada gives us like emergency low interest rates. You sit there and say, well, it's actually a little bit affordable here. And as long as certain pockets of the market are not feeling massive job unemployment and layoffs as we see in the States. So Canadians are feeling more confident, and with lower interest rates, they're spending money.
Now, how confident are you in this prognosis? Because, I asked this question, because over the past year, a couple of things happened which we're not used to. One is interest rates just got crushed. I mean, they couldn't possibly be lower, so mortgages are as affordable as they will ever be. We haven't seen that, not in my lifetime anyway, not at this rate. And in the market itself, normally the high end is protected. When there's a dip, in the economy, the high end market's protected. It's the low end where we have often seen people just stop buying and selling. But in this past year, we have seen the high end get really beaten up. So we're in kind of a place we haven't been before.
Well, I think where the incentives and the low interest rates really took effect was with first-time home buyers. And in that low end, interestingly enough, Dan, in markets like Vancouver and Toronto and certain pockets, it was that low $250,000 to $350,000 marketplace that took off first, rebounded initially. People came in. They bought in at that range. That allowed people in the $400,000 to $500,000 range to move up a little bit. And really, it was almost the luxury items that took the biggest hit in the recession. Mm-hmm. So people who were maybe thinking, think back in 2006, people were sitting there going, yeah, that's really expensive. But you know what? As long as my self-employed new career, my job, my commission is going to keep going the way it has the last 3 years, I'll go out on the skinny branches and take a chance on that high-ticket item. It comes back to consumer confidence. I think people got nervous, and the area it was hit the hardest was on the high-end luxury items.
So what's going to help then is if we think the worst is behind us now, I mean, we're not out of this. Employment's got to come back a bit. But if we believe that the worst is behind us, that's going to boost consumer confidence. But if we do get a sharp rise in interest rates, what would happen then?
Well, that's a big concern. And I think one of the things that's going to keep a lid on a sharp rise, I think that's a little bit overblown because on one hand, the Bank of Canada will raise rates when they start worrying about inflation. When they shift their focus from stimulation to inflation, watch for a rise in rates. But what's going to put a lid on that is the high cost of the Canadian dollar, which in my opinion, I think that the U.S. government will probably look to pay off their $1 trillion deficit with a deflated dollar, which in turn will create an inflated Canadian dollar. And I think the Bank of Canada is going to find themselves between a rock and a hard place, worrying about keeping a lid on inflation on one side, but the high Canadian dollar is going to force them into keeping rates lower for an extended period.
Peter Kinch, the author of 97 Tips for Canadian Real Estate Investors. Thanks very much, sir. Appreciate your time.
My pleasure.
For years, we've been told to wash our hands. That helps keep the flu at bay. But now, Maybe not. The second wave of swine flu has arrived, and Canadians are receiving a mixed message about what to do to help protect ourselves. A 2007 study found the virus was mainly spread through airborne droplets, and that there was no evidence that hand hygiene prevented the transmission of flu, but some health workers dispute the research.